welcome everybody. I'm Denise McCarthy from Cody and McCarthy, and Justin McCarthy, in case we couldn't have any more McCarthys. No relation, but we will be hosting this presentation together. So thank you everyone for joining. We actually gave this presentation back in November, mostly to accountants, financial advisors, folks kind of in the business trying to understand the new law. And even since then, there have been we've gotten clarity, I should say, as to the interpretation of some of the law. So we'll be able to provide you guys even more information today. But we're happy everyone is joining us. So Justin, you're powering slides, right? Because that is on.
Yes.
Very good. We just wanted to start quickly, though, because we know we've got a much broader audience of folks today, people coming at this from a personal perspective, or maybe it's part of their own business. Just want to make sure everybody understands what the estate tax even is, because interestingly enough, most states don't have an estate tax. So what it is, what I always explain to clients is you kind of have to erase from your mind what you know about income taxes, because most people kind of catch on to that. You earn income, the government takes a percentage of it every year. Completely separate from that world of income taxes is estate taxes. Estate tax is a transfer tax. So gift tax and estate tax kind of get lumped together as transfer taxes. So what they're taxing is the transfer of wealth from one person to another. And it's usually from one generation to the next, because between spouses, you can leave an unlimited amount of assets. You can gift an unlimited amount of assets, provided you're both U.S. citizens. So generally, you're talking about the transfer of wealth from one generation to the next. And similar to income taxes, both Massachusetts and the federal government assess an estate tax, although they only do so if you're over a certain threshold amount. And as I said, most states don't even have one. So this is kind of unique to Massachusetts and about 12 other states. So the threshold amount is different from state to on the state side versus the federal side. In Massachusetts, and this is basically the whole core of this presentation, the exemption amount, the threshold amount used to be $1 million per person. So if you're a married couple, you could each leave $1 million to your kids, provided you did proper estate planning. And it's not a per kid number, it's a per person doing the transferring that can leave the money. And now they've bumped that up as of October. They bumped it up to 2 million. They changed law in October, but I should say it's actually effective as of January 1, 2023. So any people that passed away from that date forward are able to leave 2 million estate tax free to their loved ones. On the federal side, the estate tax exemption is much, much higher. So you're currently, I think it's 13.61. It gets adjusted for inflation every year. So it's roughly just over 13.5 million per person currently. That exemption you'll see in the news as well, because that exemption is set to drop January 1st of 2026 to 5 million per person. Also adjusted for inflation, expected to be around 7 million per person. So we have some clients that are exposed only to the Massachusetts estate tax, some clients that are exposed to both Massachusetts and the federal estate tax. Justin will explain all the rates in Massachusetts and how that gets calculated. But on the federal side, it's generally 40% on what you're over. So that tends to be a much more intimidating estate tax once you're exposed to that. But essentially what happens is someone has passed away, you're taking a snapshot of their net worth, which includes all of their assets. So their, real estate, business interest, retirement accounts, including qualified accounts, Roths, all of it, all gets included in this calculation of their gross net worth as of the date of their death. And then you're going to take a look and see, okay, if that was in total under 2 million, well, under the Mass tax law, now you're not going to have to do any type of estate tax return filing. You're not going to have to pay any estate taxes. So you're basically taking a look at what their net worth was against those thresholds, and then working to figure out what estate tax is due either to Massachusetts or the federal government. So that hopefully kind of lays the foundation for what estate taxes are. And Justin, feel free to add anything if you want. But I'm going to let Justin kind of take it away and walk you through what the law was and what has changed. And then we'll start going into how this impacts you and what you should be thinking about.
All right. Well, thank you, Denise. And no, I think you summed it up pretty well. I thought it was important just to go over what exactly an estate tax is. And I think it'll help give those watching some context as to the changes that have happened and how, we've been reviewing the changes and how those changes might be important to the people who've joined us today. So as Denise said, we're going to go through what's changed in this new law. We're also going to talk about what hasn't changed. And then what we're going to do is wrap up talking about estate planning and why estate planning continues to be important, even with this change in the law. Some would say more important than ever. But we'll start with this slide first, which is what has changed. So up until mid-October, we had been operating on the assumption that the estate tax was going to stay the same in Massachusetts, which is that anyone who had a taxable estate over $1 million was subject to an estate tax. So what's changed now is that the number has gone up to $2 million. So anyone who's under that number will not have an estate tax liability. For those who are over 2 million, there is now a credit applied against the tax due. And the result of these two changes is that there's been an elimination of what's called the cliff for estate tax purposes, which essentially means that once you go over 1 million, you start to be taxed back at the first dollar. So that's no longer the case. Another change is that out-of-state real estate is now included when calculating the overall gross estate for estate tax purposes. That had not been the case for the last few years, but with this law change, it does bring that back in. Although, as we'll go through the slides and see, it requires some careful analysis when determining whether the presence of that out-of-state real estate will actually result in a tax liability. And then last point to touch on just generally is that lifetime gifting now has an even more favorable impact for estate tax purposes. And we'll get more into detail about that as we go through the presentation. So on the left here is the actual text of the change in the law. And so what the legislature did is they made these changes, section 36 and 37 to chapter 65C of the Massachusetts general laws, which is the law regarding the imposition of an estate tax. So you'll see that we've bolded two sections at the bottom on the left. And so the first says that for estates of decedents dying on or after January 1st, 2023, a credit shall be allowed against the tax imposed by subsections A and B equal to the amount of such tax, provided, however, that the credit shall not exceed $99,600. So that's the credit I was just discussing for those estates over 2 million. And then Part G says that for those dying after January 1st, 2023, they shall not be required to pay any tax if the value of their estate is not more than $2 million. So big takeaway there is assets and gross estate. If they're less than 2 million, no estate tax filing will be required at all, with some caveats, which we have noted here is that lifetime gifting may result in a filing, but should not result in any estate tax liability. So what does this mean? It means that estates valued over 2 million will be subject to a Massachusetts estate tax. On those estates, a credit of up to $99,600 will be allowed against the estate tax imposed. And where does this number come from? So when we calculate estate taxes, we actually still have to look back at the old 1999 Form 706, which is the federal estate tax return, to pull out what's called the credit for state death taxes. And that's how Massachusetts calculates estate tax liability. And so that's where that number comes from.
So essentially, it's the tax that would be due if you were taxed from $0 to $2 million. They're saying, we know what that number is. It's $99,600. So they're applying it as a credit, and that is how you are getting the first 2 million free.
Exactly right. So what we've done on this slide is just actually pulled an excerpt from those instructions that we use to calculate estate tax. And you'll see that we've highlighted some numbers in columns here. And so The reason we've highlighted those specific numbers is that's actually where the estate tax starts, right? Because 1 and 2 is the bottom end of the estate and 2 is the higher end. And so that's within, you'll see number 2 says 2,040,000. So that's the range we're working in. So anything under that amount is not going to be subject to estate tax. Whereas before this law changed, we would have to look at these columns above it to determine whether an estate tax liability was required. Or excuse me, an estate tax filing was required and there was liability. Occasionally we get the question of what's the what's the percentage that you're going to pay for an estate tax? And so if you look at that column 4 that's highlighted, and that's roughly what you're going to pay, although that's going to depend on a whole lot of factors. But if you recall what Denise said earlier, the federal estate tax is about 40% on anything over that exemption. And you'll see that Massachusetts isn't quite so steep. So it's going to start at roughly 7% and work its way all the way up to about 16%. And that's on estates over $10 million in value. So as I discussed earlier, and in the previous slide, you might have been able to gather, once an estate exceeded $1 million, the Massachusetts estate tax had what's called a cliff effect, meaning that when calculating the estate tax, you actually had to go back to $1, and everything was brought back in. So the result of this was that if you had an estate in the $1 to $1.3 million range, you actually ended up paying a significant tax as a percentage of the assets over $1 million. Now with this $99,600 credit and the complete elimination of tax on estates under 2 million, there's no longer a cliff at all, because we're not going back to $1. We're starting at $2 million and one. So that's completely eliminated this cliff effect, and that's had multiple impacts. One, in terms of who has to file, who has to pay. But again, as we'll discuss later, if any lifetime gifts were made, before the change was made, we'd have to consider those, and it's less of a concern now when determining.
And I just want to give one good example, because I had this exact situation with a client just last week, because I'm working with her, looking at her parents' estate plan, but she's recalling the estate tax imposed when her in-laws passed away, and she was not understanding how if they had $1.5 million of the $1 million exemption, but her parents have 2.5, the $2 million exemption, how is the tax so different? And so what I walked her through, well, you know, before you were getting taxed from $1, now you're only getting taxed from 2 million to the 2.5. She was like, oh, well, that's very different. So I only mention that so that other people that maybe are basing their guess on what their estate tax liability is on having done this in the past, you really have to kind of reset your mind and how you think about it. And you know, you can always reach out to us. We're happy to help people through that calculation if you need help.
Yeah, absolutely. So I'm going to move to the next slide. So one big change that we've known for some time that this change was in the works, but it didn't really come to our attention until the law actually passed, is that now the state is going to consider out-of-state real estate when determining whether a tax will be due or a tax filing. Now, the old law had said that we needed to take into account whether a decedent had paid taxes to another state and use that as a credit. But really the practice for the last half decade or so had been to exclude that real estate on someone's estate tax return based on existing case law. So that's out the window, because now, as you can see in this bolded language, it says that the federal gross estate of a person includes real or tangible personal property located outside the Commonwealth at the time of death. Tax shall be reduced by an amount equal to the proportion of such allowable credit as the value of such property bears to the value of the entire estate. So essentially, how does that work in practice? And we weren't, frankly, even sure until the Department of Revenue issued the new estate tax return forms in the last month or so. So there was a good month and a half, 2 months, where we were reading the statute, but not exactly sure how it was going to be interpreted by the Department of Revenue. But we do have an answer for that now, which is that we look at the total value of the gross estate, wherever situated, including out-of-state property. Then we reduce the value the out-of-state property bears to the total value of the estate, and then apply a credit. So, excuse me, I'm going to back up. We look at the total tax due on the entire gross estate. Then we say how much of that gross estate is out-of-state property. We create a fraction, reduce the total estate tax due by that fraction, and then apply the credit. So as you can see at the bottom, may result in some cases with an estate tax being due. So just given some examples here, and I'm using nice round numbers just because it's a little bit easier to follow. But if we have a Massachusetts resident who has $3 million in assets, and they own a very nice house in Florida worth $2.25 million, a filing will be required, but no tax will be due. So under the previous law, as I was just saying, we would have just excluded all that real estate in Florida, and that would have left the person with less than $1 million in assets. So we wouldn't have filed an estate tax return at all. But under the new law, what we have to do is actually calculate the tax on the entire amount, which is $182,000, and then prorate the tax due. So roughly that works out to $45,500. So if you'll recall from a few slides ago, we can apply a credit of up to $99,600 against any tax liability. So the result of that is it wipes out the liability entirely. We still have to do the filing, which isn't ideal, but at least you don't, the person won't owe any money to Massachusetts. So, but as we kind of dive into these changes in the law, we had been thinking that perhaps if someone had less than $2 million in Massachusetts real estate, or excuse me, of total assets, excluding out-of-state real estate, that there wouldn't be a tax due. But after running some numbers, it actually turns out that there may be some liability, though it is, so it's very fact specific as to what the liability will be. But if you look at this example, if a Mass resident has $3.5 million in assets, and again, they have a very nice home in Florida, we actually have to file a return and a tax will be due. Because, as I said, even though the assets in Massachusetts are less than 2 million, we have to look at the tax due on the entire amount, and that's $229,200. And because half the assets are outside of Massachusetts, we cut that in half. But remember, we only have a credit up to $99,600. So the resulting liability is about $15,000. So the way non-residents owning Massachusetts real estate are taxed hasn't changed, but this change in credit does impact calculating a person's tax liability and whether a tax is due. So just stop and say, the examples before we're talking about Massachusetts residents who own out-of-state property. Now we're talking about the Florida resident or the New Hampshire resident who owns a home in Massachusetts. And how does this change in the law impact them? So the answer is that if a Florida resident has $2.8 million in assets, 700,000 of which is a home in Massachusetts, there will be a filing requirement, but no tax due. Now, under the old law, filing would be required and a tax due, because even though the total assets were over $1 million, the home, sorry, excuse me, there's a typo in this, but even though the assets in Massachusetts are less than $1 million, there still would be a tax due, because it would basically be a reverse treatment of what we were just talking about, where they would look at the entire amount of assets, calculate a tax, prorate that tax. So because of that, there would have been a tax due under the old law. But now, as you can see, if we look at the total value of the estate, we calculate the estate tax, we prorate the tax, which results in $41,200 tax due. And if you'll remember, again, that $99,600 number will wipe out any tax liability. So again, a filing requirement, but no tax due on the estate. So as you can see, there's some complexity here, and we're still working out exactly how it's going to work in practice. There isn't really a black letter scenario that you're going to have a taxable estate. You're not going to have a taxable estate. It's all going to depend on, one, if you own out of state property, what is the value of that property in proportion to the total value of your estate, and that will determine whether an estate tax will be due.
But one thing that is clear, and I've heard people in conversation talk about this incorrectly, even advisors, CPAs, people that I'm sure do know the law if you drill down on it, but casually speaking about it, will say, oh, if you're not over if you don't have $2 million of assets in Massachusetts, you don't have to worry about the Massachusetts state tax. That is false, because as Justin just walked you through, if you have $2 million of assets, period, and if you have something in Massachusetts, you're going to have to file an estate tax return here in Massachusetts. Whether you end up having to pay estate taxes, that's where you get into the weeds of the numbers and doing the calculation and the proration, but you would have an estate tax filing for sure.
Yep, absolutely. So again, if you're under 2, wherever you are, then there's not going to be an estate tax filing. But if you're over 2 with these assets outside, then there is the question of whether a filing will be required and whether a tax will be due.
Justin, we'll just pause for 1 second because there's one question just clarifying what's being prorated. So the proration, so you're taking your gross taxable estate and you're figuring out the estate tax on that full amount. And then you're saying, okay, how much of the assets are in Massachusetts and how much is out of Massachusetts? And if that's 50%, then you're applying that 50% to the estate tax. And prorating it. So you should only be paying estate taxes the way Mass looks at it as on the Massachusetts property.
Exactly.
All right, very good.
Yep. Okay. And then let me see. So that's that slide. So next we're going to talk about lifetime gifting. And there's this change in the law actually has resulted in some fairly significant changes for the impact that lifetime gifting can have. All right, and Denise, I'll turn it over to you because I think.
Sorry, I was paying attention. I was paying attention to the chat, because there is still a chat function. So if people submit questions, probably Justin will keep an eye on them now. So you are lifetime gifting. All right. So so lifetime gifting. So this is kind of interesting because this is another thing where I often hear people start throwing around the threshold amount that it used to be $1 million. Now it's 2 million, saying, hey, as long as you're not over 2, don't worry about it. You're good. That is step 1 is, are you over 2 million now? Sure. If you're over 2 million as of date of death, you're going to have an estate tax return required to be filed. But the next question is, were you over 2 at some point and you made big gifts? So if you made gifts in excess of what we call the annual exclusion amount, which is currently $18,000 per person. So essentially you're allowed to gift $18,000 per year to as many people as you want. It's kind of a complete exemption to the transfer tax rules. It's kind of freebie amount that you can give away. If you went beyond that, because you are allowed to give gifts beyond that, and there's no gift tax liability, but if you go beyond the 18,000, you do have to file a gift tax return, because effectively on the federal side, you are consuming some of that threshold, that lifetime estate tax exemption amount that you have. Can be used to death. It can be used during life. So if you gift beyond the 18,000, you are in fact using some of it. So if you go beyond 18,000, you're going to file a gift tax return with the IRS to tell them that you've used some of it. In Massachusetts, if you've made gifts that required you to file a gift tax return, you have to bring those back into the value of your gross taxable estate, only for the purpose of determining whether you have to file an estate tax return in Massachusetts. So if you pass away now at date of death in 2024 and you have $1.9 million, if you look at all your assets and your executor, whoever's settling your estate says, great, no return necessary, no estate taxes, But then they find out you filed a gift tax return because you gifted a child a $300,000 house however many years ago. Well, now you're going to do 1.9 plus 300,000. You're over the 2 million. So now you're going to have to file a gift tax return. So under the old law, that would have actually resulted in there being a small amount of an estate tax due. But under the new law, the way that estate tax is calculated, it doesn't. So you have a filing requirement, but no estate tax due. So a little bit annoying. A lot of practitioners are like, well, what is the point of filing if there's not going to be a tax due? But maybe that gets cleaned up at some point when they, so they see this, how the new law kind of plays out in application. But that is how it works now. So it's actually better for a lot of our clients that have made gifts, because you don't have to worry about there, potentially being a small estate tax. Those gifts are, as long as they're done properly before the person passes away, they get the full benefit of that.
Yeah, exactly right. And just to that point, Denise, the Department of Revenue did issue some guidelines for these changes in the law. And if anyone is so interested, they should be able to look them up by going to their website. But one of the things they do emphasize is, yes, that you do have to bring back in those lifetime gifts, even if at death, a person has less than $2 million in assets to their name. Next slide. Okay, so I'll go on this one. So what hasn't changed? So one thing that hasn't changed is there's no portability of the mass estate tax exemption. And if you recall back at the beginning of our presentation, Denise was talking about the federal estate tax and its very high exemption amount. But what you can do with a federal estate tax is you can actually port that between married couples. So if you have a married couple and one passes away, that couple, that deceased spouse's exemption of 13.6 million can actually be transferred over to the surviving spouse and effectively shelter roughly $27 million in assets from estate tax at the federal level. Massachusetts does not have that. So there, for now, with this law change, again, the first law change in about 17 years, there is no portability of that exemption. So that exemption still needs to be used at the death, at someone's passing, in order to, or it goes away. Again, the federal exemption goes up every year automatically because it's indexed to inflation. So it went up, I think it was 12.9 in 2022, it's 13.6, or excuse me, 12.9 in 2023, 13.6 in 2024. But Massachusetts for now did not make an adjustment. So it's still that hard $2 million number, and that will not be going up over time. And again, non-residents are still taxed for owning real estate in Massachusetts. As we demonstrated, though, they now get the benefit of that 99,600 credit. So this is one of those, it hasn't changed, but it has when determining the liability for an out-of-state resident.
All right, so this is where I kick in, right, Justin?
It is, yes.
Just make sure I don't want to talk over you. So what does it all mean, practically speaking? Kind of one of the biggest changes in our minds in terms of having to file state tax returns is taking a harder look at the out-of-state real estate, because it's something for so long that was kind of nice and easy to say, oh, okay, we're going to look at all of your assets. Oh, Florida house, no problem, we can ignore it. New Hampshire house, we can ignore it. Unless that particular state happens to be one of the states that has their own separate estate tax, you could really in large part ignore having to account for the value of the out-of-state real estate. Now you really have to go, but you have to grab the value of everything, which means getting appraisals out of state. And that can sometimes be a huge hassle for folks. So certainly just adds to the cost of these estate tax returns and the complexity of determining whether there is or isn't an estate tax due. Estate tax planning is something that is so much more important now. Can't stress that to you enough. We often find, I mean, I literally just looked at an entire estate plan this morning that was 100% focused on Medicaid planning, did nothing for estate planning, is going to cost these people about $180,000 more than they needed to pay at all. They didn't need to pay anything, is really what it came down to. So we can't stress that enough. You need to be working with estate planning attorneys that focus on tax planning and have that experience, because it's so critical to how you look at a lot of these issues. And if you go to the next slide, I'm going to walk you through kind of a general set up of a common trust-based estate plan that is designed to do estate tax planning, so that everybody's understanding how that works. There are two major ways to make sure that a couple uses each of their exemptions, because simple will plans where you have, okay, I have this will, I don't have a trust at all, I'm leaving everything to my surviving spouse. That's going to take everything that a couple owns and ensure that it passes through one spouse to the kids or whoever the beneficiaries are. That the exemption of the second spouse to pass, that exemption is the only exemption that's going to get applied to those assets, because all of the money is transferring through one person. So when you have a couple, you each have a $2 million exemption. So we want to be using both of those exemptions. One way to do that, very common way, I'd say, outside of this firm, because we tend to favor this joint trust for a married couple scenario, and I'll explain why. But one way to do it is each person in the couple has their own revocable trust, and they literally split their assets. So some of them are owned by one spouse, some are owned by the other spouse, so that ultimately, even though they may choose to leave the assets in each of their trusts for the other spouse while that spouse is still alive, they will ultimately, the children or beneficiaries will inherit from mom's trust, dad's trust. So there will be two separate trusts, two separate exemptions that get used. What's a little bit obnoxious about that is having to balance the assets, and clients all the time come to us with those two separate trusts, not understanding why they have two trusts, not understanding what to put in each of the trusts, and how to balance the assets between the trusts. So we tend to favor the joint trust, which is this arrangement here, which is there's one revocable trust that the couple uses, and you put everything into it. So all the assets go into the trust. The only exception to that for the accountants on the room is you don't want to put your qualified accounts into the trust during your lifetime. They'll flow in after both people in the couple have passed away. But pretty much everything else ends up in the joint trust. And then the division happens after one spouse passes. So you essentially, you create sub-trusts. They can be called really whatever you want them to be, but most commonly they're called the family trust or a credit shelter trust. That first sub-trust, you will fund into that trust up to $2 million of assets. And that is because that is where you are going to apply the Massachusetts estate tax exemption of the first spouse to have passed. And the way you do that is you file an estate tax return with the Department of Revenue, and you let them know, okay, this trust is being set aside. It's applying the first spouse's exemption. All of the excess of the assets will fall into what's called the marital trust, to then be taxed only when the second spouse has passed. So when the second spouse has passed, his or her exemption will be applied to that bucket. So the first $2 million of that trust will be estate tax free as well. So you'll see, you'll have family trust pass to the beneficiaries. Everything in it will be estate tax free. Marital trust will pass to the beneficiaries. Everything over 2 million may be taxed, but 2 million will be estate tax free. So you will have effectively used the $2 million exemption of each spouse. So that is a very common arrangement. So when we're meeting with new clients, if we're seeing folks that are over 2 million or going to get there just based on, age and income potential, et cetera, we are encouraging them to have this kind of arrangement, because if you're going to fully utilize one exemption and you need the subtrust to then use the second spouse's exemption, we want them to have that set up, because ultimately if you stay between, if you stay under 4 million total, the beneficiaries will pay no estate taxes. So let's move on to the next slide, and we may come back to that one, although I don't think we have to. So some considerations, a lot of you have that set up already. If you're existing clients, you have a joint trust that takes advantage of both of your exemptions. Well, who who needs to be thinking about revising their estate plan, coming in to see us to make changes to their estate plan, given this change. So if Justin, if you can jump to the next slide, I think it's easier to have a visual when I talk through this first point.
Okay.
So if your spouse has already passed away, and you take a look at the total value of the assets. So now we're looking at the family trust and the marital trust. So now we're talking about the trust I was just talking about, but it was a joint trust, and now it has divided because one spouse has passed. If into this family trust, you would have been capped at being able to fund $1 million, because that was the current Massachusetts state tax exemption when that first spouse passed. If you look at that trust and it's got $1 million, and you add in what the surviving spouse has in their name, and if that entire number is under $2 million, you would want to come see us. And the reason for that is because there's an income tax disadvantage to having assets in this family trust. So yes, it's bypassing estate taxes, but it's not getting favorable capital gains tax treatment. And for that reason, you may want to distribute the assets out of that trust. But you would definitely want to have a discussion with the estate planning attorneys that helped you set this up, because if you're talking about a second marriage situation and who the beneficiaries are of this family trust, there are other factors you have to consider. But certainly that's a big one, where a big scenario we're looking for is are the total assets going to be under the current $2 million threshold? Could we optimize income tax planning as opposed to estate tax planning? All right, so if you go back to the slide prior, similar concepts, but people that have made gifts thinking that they were going to have Massachusetts estate tax exposure, because they say you had $2 million and you are, you're single and you're thinking, geez, I got a whole $1 million exposed to the estate tax. You start giving away assets into maybe an irrevocable trust or some other, mechanism for removing assets from your taxable estate. And now you're saying, oh, geez, if I had held on to that, all of these assets would get a step up in basis, which means better capital gains tax treatment for the recipients of the assets. And I wouldn't be paying estate taxes. It's kind of a non-issue now. So those are folks that we want to be meeting with and talking to as well, because sometimes there are ways to undo those gifts and try to get, again, better capital gains tax, income tax treatment, because the estate tax is less of a consideration. Another thing to look for, particularly if you are not a Cody McCarthy client, because we vary as long as I've been here for 15 plus years, and as long as the firm's been around, my guess is we've used these funding formulas in order to fund those two sub-trusts. So the family trust and marital trust, where it says how much goes into the family trust. We never wrote in our documents, put 1 million, and now that would mean we'd be buried alive in work right now doing amendments to trusts to say put $2 million in that family trust. We contemplated the fact that the Mass estate tax exemption may have changed, because the federal one changes all the time. So we use a funding formula. So it basically says whatever the current estate tax exemption is in the state is how much is going to move over to the family trust. But not all practitioners will have done that. They may have used different mechanisms for moving assets into the family trust. So you would definitely want to be evaluating whether the tax language in your trust works. And that is often something that needs to be looked at anyway. If you've got trusts that are pre-2011, they could have language that doesn't contemplate the federal estate tax exemption being so high, because it was not at that time. Pre-2002, you may have a language that doesn't take full advantage of the Massachusetts estate tax. So that's a common area. That's one of the big reasons we suggest people don't go longer than like 5 to 7 years without touching or reviewing your estate plan at all, because those things can change. But if you're talking about just going from 1 to 2, no other changes, that probably is not something you have to change in our trust. But consider whether any of the other items we're talking about today strike a chord with you, and then set up a review if you think it's necessary. I think, not to pat ourselves on the back, but we are starting to get this feedback that the use of the joint trust versus what I had talked about with, okay, you're going to have married separate revocable trust and trying to split the assets and balance the assets. That seems to me to have been easier to do when you had a $1 million exemption, because it might have been easy. Okay, we're going to put, you have a $3 million brokerage account. Great, we'll split it. Or the house is worth $2+ million. We'll put half the house in each trust. And without much work, you may have made sure that there was $1 million of assets in each of the trusts. So you knew it didn't matter who passed away first. There was always going to be $1 million in each of those trusts, so you could apply the estate tax exemption. Well, now you got to go to 2. So now you have to have 2 in each trust. And then it becomes who's going to pass first, who's going to pass second, would they sell the house, what are we going to do with the step up in basis? It seems to be much easier to make all of those decisions if you've got one joint trust. So the simplicity of trying to manage assets in one trust, now having really impacting the administration of the estate when one person passes away, that is something to very much consider. And we have had a lot of people migrating, like new clients that had married separate trusts with other firms, kind of migrating over to the joint trust because it is easier to manage. Another,
I can
go
take
ahead,
this
sorry.
back too. That's okay, unless you want to.
Oh, did you want to talk about this?
Yes.
Sure, go ahead.
Okay, so some other considerations are if you own out-of-state property, how do you own that property? Because as we've been discussing, if you have that out-of-state property that's just in your name or in your trust, there's going to be a proration of tax liability. But sometimes what people do is they put property into an LLC for many different reasons. But what that actually does is convert real property into what we call intangible personal property. And so if you're a Massachusetts resident owning a property in an LLC that's out of state, what that actually does is it has the potential for eliminating the proration for that asset, because Massachusetts will say, well, this is your intangible personal property, so you don't get to prorate it out even if it owns real estate outside of Massachusetts. So that's something to potentially consider. I mean, there is some flexibility, some arguments that can be made that should still be prorated, but it's, again, fact specific as to the type of property. But that is something to keep in mind. So out of state residents actually get the opposite treatment. So again, if you're that Florida, New Hampshire resident owning Massachusetts real estate, you might want to consider an LLC to own that property, because that actually, again, converts it from real estate to intangible personal property. And because you're an out-of-state resident, Massachusetts can't tax your intangible personal property. It can only tax your real estate or tangible personal property that's located within Massachusetts. And then the last point on here, and this is, we could spend considerable time on this, but for those who are out-of-state residents or consider themselves to be out-of-state residents, you actually have to prove to the Department of Revenue, or whoever's filing the return has to prove that you are not a Massachusetts resident. And you commonly hear people say, well, I did the 180 days and a day, and that's, in Florida or New Hampshire, so I'm a resident there. And so that's absolutely a factor, but that's not the only factor. There's actually a form we have to fill out for non-resident estate tax returns. It's called a non-resident affidavit, and it has roughly 28 different questions that they ask about where did the person file taxes, where did they vote, did they have a driver's license in Massachusetts? So there's a whole broad range of factors to take into consideration for those non-residents who are trying to reduce or potentially eliminate mass estate taxes. So again, it's not just spending a certain amount of time in one place. It's a variety of factors that are taken into consideration. Okay, so let's see. So we talked about this slide.
Yeah, we talked about that. If you go to the next slide.
Okay.
We get this question a lot. So a lot of people ask us, okay, oh wow, the exemption went up. Nobody's going to be doing trust planning, or nobody's going to want to do estate planning anymore. I mean, that couldn't honestly be farther from the truth. And so for that reason, like, sure, whether you need to have a trust and there's an estate tax benefit to your beneficiaries, that is a factor in deciding whether you have a will-based estate plan or a trust-based estate plan. But I would say the majority of our clients choosing to have trust-based estate plans are not doing it solely for the purpose of estate tax savings. That's a benefit of a trust, but we wanted to highlight for you guys some of the big reasons our clients choose trust that have nothing to do with taxes, or in some cases it's tax, but it's not the Massachusetts estate tax. So flexibility and control over trust assets. This is a huge one. Whether you're doing an estate plan because you have minor children, so they're young, or you have older children that are not capable of managing assets, whether it be because they have special needs, or maybe they're just not great with money, they've never managed money, you're worried about a divorce. We'll talk about that as well with asset and divorce protection. But if there's some reason that you don't want the child to come into full control and management of the trust assets, your trust that you designed during your lifetime, yes, it might do some estate tax planning for you to save the kids money. There's this next question of, okay, does it terminate after the two of you have passed, or does it continue because you've decided to offer provisions within the design of the trust that offer benefits to the children? So you can make sure that it stays in the bloodline. You can make sure that it doesn't, go to a divorcing spouse. The asset protection, divorce protection piece is a huge reason people choose to have assets in trust, right? So if you're worried that your child might get divorced and you really want the assets to stay for your child and grandchildren, you want it to stay in the bloodline, folks design trusts with either independent trustees or a combination of independent and interested trustees, so maybe members of the family with an attorney or someone outside the family, to control the distributions out of the trust. So depending on who the trustee is of the trust, if it's not the child or the beneficiary, the person receiving the funds, that trustee is basically the gatekeeper as to the distributions out of that trust, and that is offering asset and divorce protection. That's a huge reason people continue to use trusts, and will probably as far as I can see, forever. Another really interesting use of a trust is to offer estate tax planning for your children. So we see this more and more now as more people are having trusts. If you leave your assets to your children, even if it's in a trust, and you dissolve that trust and you make an outright distribution of your assets to your children, they will inherit the assets from you, and that will become part of their assets. And if it's part of their assets, it is part of their gross taxable estate. So if you've got a Massachusetts family leaving assets to their children that are in Massachusetts, well, they live in a state with an estate tax. So to the extent those children already have home, life insurance, even young families, have death benefits of $1 million, $2 million for life insurance policies. These are all part of your gross taxable estate. So when they inherit from you, you are adding to their estate tax exposure. If instead you have a trust that continues for the benefit of that child, but doesn't dump the assets directly into their name, and you can do this one of two ways. You can either opt for asset and divorce protection because you want that for the child, or you can say, I don't really care about that. But I don't want to put them in a bad estate tax position. I'd like to skip a generation of estate taxes. You could make the child their own trustee, and your trust essentially continues at the control of your child, and then they can access the distributions for their basic needs and support, so they can use it over the course of their lifetime. But then when they leave it to that next generation, it will bypass the state taxes. So a tax reason for continuing to have a trust, but not Massachusetts state taxes at the death of the couple. Incapacity planning, also a huge factor for our clients. So trying to streamline that gray area where there's cognitive issues, whether it be dementia or some maybe there's a physical disability that's preventing someone from kind of being out and about in the world, conducting their own business. That happens a lot the longer people live. So the trust, having all the assets housed in one trust, really facilitates a nice smooth transition to a child or whoever it is that they've picked to administer their affairs during that incapacity period. They just take over as trustee. They're not having to go, okay, bank, here's my power of attorney. Okay, doctor, here's I have authority to sign this contract, enter facility. If everything's all in one place and that person has access to the assets through the trust, that makes for a much smoother incapacity period. Anything else, Justin, that we wanted to touch on there?
No, I think that pretty much covers it. Yeah, again, just to to recap, I know the focus on this slide is estate tax planning is just one portion of estate planning. But again, to just reemphasize that married couples don't automatically get that $4 million exempt. They actually have to do some estate tax planning through trusts in order to get that benefit. But again, trusts are an incredibly versatile and really just a great part of an estate plan because of the flexibility and choices they give to people who are creating them in terms of kind of setting up their loved ones for this inheritance and trying to anticipate issues that might arise in the future, none of which you're really going to get with just a more of a straightforward will plan.
There are two questions. If anyone has other questions, they can either email us. We've put our email addresses up. Oh, wait, we didn't put that on screen yet. Sorry.
Oh, yeah, I can
see one slide ahead. So
there we go.
There they are. So you have our email addresses. I'll try to answer the first question that is out there is from an anonymous attendee. I'm not sure I quite understand the question, but I think they're trying to understand the interplay between the federal and mass estate tax exemption. So that may be kind of outside the scope, but I'll try to explain it as in simple terms. So essentially, if one spouse passes away, it's kind of an overlap as to, so their Massachusetts estate tax exemption amount, that $2 million gets set aside. It's also consuming $2 million of the federal estate tax exemption. So everything over that, when the second spouse passes, will be included in their gross taxable estate, and therefore they'll have the $2 million of the surviving spouse. This is assuming they've done proper trust planning that Justin was just talking about. They'll have the $2 million exemption in Massachusetts of their own to apply there. And they may have used portability to get some of the federal exemption that the first spouse to have passed left behind essentially didn't use, or they might have enough exemption of their own to cover the excess. But hopefully that answers the question. If not, just feel free to email and we can jump on the phone. And then someone has also asked for a link to the mass affidavit form that proves you are not a mass resident. That is not, I don't think it's an affidavit so much as a things to consider, because it's a factual analysis. So it's kind of like a checklist, right, Justin?
Well, it's what's called an MNRA. So it's just, again, it's got those 28, 29 questions that they ask. When we file an estate tax return for someone who's not a resident, we have to file that because the Department of Revenue is always going to assume that if you own Massachusetts property, you're a Massachusetts resident. So you have to prove otherwise to them. I don't have a link handy, but I think it's called the form MNRA. It should be on the Department of Revenue website.
And again, just email if you can't find it.
Mm-hmm.
Thank you so much, everybody, for participating. I'll try to be respectful of everyone's time. I think we've answered all the questions. And just feel free to email us, like I said, or reach out if you feel like you need an appointment to review your estate plan, or if you've not done estate tax planning and you think it would benefit you, then definitely reach out.
All right. Thank you, everyone.
Thank you. Bye, everyone.